Hey traders, ever wondered why market seems to hit your stop loss and immediately reverses? You're not alone. And today we are breaking down the concept of liquidity. And by end of this video, you will master all types of liquidity you need and how to use them. So dear trader, this is what you learn into this lesson. Mastering liquidity. Number one is what is liquidity. After that, we treat buy side and sell side liquidity, followed by internal and external range liquidity. Then we look into liquidity sweep. Some call it liquidity grab. Then liquidity run and draw on liquidity. These are the things we learn in this video today. By the end of this lesson, you will join the big players to take people out from the market. If that sounds good, let's begin. So guys, let's begin with sell side liquidity. Whenever you hear about sell side liquidity, this is the liquidity that sits below support level or swing low. Think about this. All retail traders who went long in this very setup you are seeing here, because this is very nice support zone, where do they put their stops? Right under the low. Even you can equally do that, and you are still doing that as well. So when price drop below that level, it triggers those sell order, both breakout traders and people who went long in that position becomes liquidity, and the institution can use that to enter their long position. The same thing can be, so now you have known what is sell side liquidity. Now let's flip it to buy side liquidity. Whenever you hear about buy side liquidity, it is just a liquidity that sits above highs or resistance. You can see at this very image and displaying your screen. Traders who went short place their stop losses up there. When price breaks out, both breakout traders and people who place their stop loss to go short there, it hit those buy stops, creating a rush of buy orders. This allows smart money to fill their short position using your stop loss as their end. Here is the real example on how this play out. See this equal low. Retail traders go long. Stop loss are right under here. Price dips, grab the sell side liquidity, and boom, reverses. That's smart money in action. They are not hunting you personally. They are just using the liquidity you leave behind. So you must master how to use liquidity for you not to be a liquidity next time. So how do we use this? It's very important. The first thing you need to do is to identify a liquidity pool above high or below low. Wait for liquidity grab, breakout with a strong wick or reversal. Look for confirmation, breakout structure, or any entry model you know. Trade the opposite move after the liquidity is taken. Instead of trading the breakout, wait for the trap, then trade the reversal. To wrap this up, sell side liquidity equals to below support or lows. Buy side liquidity equals to above resistance or high. And knowing where those are can help you stop getting stops out and start trading with smart money. If you have learned something, hit the like button and stay till the end, because more is still coming. Next topic is on that way. Next topic, guys, let's look into internal range liquidity and external range liquidity. When price ranges move sideways, it builds two sides of liquidity. This normally happens in a trend. Number one is internal range liquidity, which is inside the range, and the external range liquidity outside the range. We have to take it one by one for better understanding. Looking into internal range liquidity is a range or consolidation that happens in a trend. So I have a little diagram here that will explain it better. We have a bearish market here and bullish market. On this bearish market, where is our internal range liquidity? Is inside the zone where we have other block, fair value gap, and all sort of liquidity sitting there. It can be, but mind you, you can only satisfy this internal range liquidity with this statement. The statement is this: when downtrend, we have a breakout structure. After that breakout structure, price pushed back, create a high and low, another high and another low. You understand? So this movement you see here is a liquidity. It's not the remove. The remove when price will take out this high, and as price take out this high, we have confirmed another lower low, and the new external range liquidity is created. You can see that. So all these highs you see here, fair value gap created inside the zone, another pullback here, all these things are liquidity. That's why we use this as endorsement, decisional order block, and the extreme order block. So the same thing applies if you are in uptrend. Our internal range liquidity sits inside the range after the break of structure. The minor pullback that happens, the fair value gap that is created after break of structure and other things is what we use as our internal range liquidity. I hope this is clear. Now let's look into external range liquidity. External range liquidity sits outside the range. That's where remove happens. You can see that this is our external range liquidity. This is our external liquidity. Institution like it very well. Then let's look into example for better clarity of this. So looking at this live example, can you be able to identify external range liquidity and the internal range liquidity from the diagram we shown earlier? So this is our break of structure. We are not trend, right? So after this break of structure, looking inside this range, because we say that internal range liquidity happens inside the range, do we have any sort of liquidity sitting there? This is a valid pullback. You see, we have this pullback here. This internal range fair value gap you spot here is internal range liquidity, internal range as well. You can see the reaction. Some people use it as their entry, but it's another liquidity because they are likely to step out, and they see what happened there. Where is our external range liquidity? External range liquidity sits outside the range. See it? This is our external range liquidity. Why is it external? Because it has moved back, take out internal range liquidity. So here is a confirmed higher low, right? External range liquidity sitting down here is this because of the break of structure that happened. You see how it works. Now that you have known this, how do we use this in trading? Whenever you have a break of structure in uptrend, you must identify your internal range liquidity. If it is there, it is there. You don't need to look to why. Any pullback that happens here is inside this range is a liquidity. You have to use one as your endorsement, one as your decisional order block, or decisional anything. Decisional. You can use it, you can gamble there, but you must see liquidity that price have to take out. Price must engineer it before that will happen. They can see breakout traders will be here looking for opportunity, and those people who say they're pending order here will be also waiting for price to mitigate, and they see everybody is a liquidity. People who use this fair value gap is also a liquidity. The remove happens when those liquidities are out. You can see when those liquidities are out, then the remove happens, right? Because somebody who trade breakout from this as well, you can see everybody was out. They have hope that they are going to make after this closure. They entered and price take everybody out and direction. That's how internal range liquidity is used and external range liquidity is used in trading. So pay attention to everything called liquidity. It will save you a lot of things. Let's move to the next topic. Next is liquidity sweep. So guys, I want to ask you a simple question. Have you ever watched price break a key high or low only to reverse immediately? That wasn't a fake out. It's just a liquidity sweep. A liquidity sweep happens when price moves beyond a key high or low to grab stop losses or pending order, then quickly reverse. It is not random. It's how institutions and smart money find the liquidity they want to enter big trades. They can't just market buy or sell millions. They need to trigger other stop losses to feed their position. So liquidity sweep usually happens at obvious price level, like equal highs and equal lows, previous swing high and lows, key supports or resistance zone, session high or low. What I mean section, I mean London and New York. Retail traders love those levels, like me and you will love those levels. And guess what? So do institutions, just for different reasons. They use it for hunt on liquidity, but we use it for our place of stop loss. So we need to stop doing that. Let's show you a quick example. Here, price builds a clear resistance with a multiple touch. You can see that this is very nice resistance zone to go short. A retail trader like me and you will definitely go short, placing our stop loss above the level. Price breaks above, trigger those stop losses, including breakout traders, because they will find the opportunity. They have been induced into the market that price have break this level, definitely we are going into the next range, and afterwards everything becomes liquidity.
and slacks down. Okay, how do we trade this? Because it's very important. We're now going into details on how to trade. We are just giving examples of how liquidities are formed on the chart, but we have to tell you how to do that. The first thing you need to do is to identify a liquidity zone. Look for a clean highs or low, especially if it is obvious. If it's not clear to you looking once, it's not clear if you look it twice. That is the rule if you want to survive in trading. Don't force your eye. If it's not clear, it's not clear. Wait for liquidity sweep. Price should break the level with a momentum. We need pressure. If it is 15 minutes zone, we want at least by 5 to 7 minutes of the 15 minutes time frame, the liquidity have cleared out. You will see the momentum push. 3. Look for confirmation, a strong rejection candle, break of structure or shift in market structure, any type of entry. We're not going to that, we're just listing how to do that. Entry on reversal with a proper risk management, of course. You are basically doing the opposite of what trap traders are doing. You are trading after the liquidity is taken, not before. So bonus tips: combine liquidity sweep with high time frame zones or session open. Sweeps around New York open, then where the big moves often happens. If you're still watching, kudos to you. Your resilience show you must make it through trading. So if you haven't subscribed, do yourself a favor and do us a favor. Subscribe and like, share the video, turn on the notification bell. Whenever we drop things like this, you will be the first people to get the information. So we are moving to the next topic.
This is second to the last topic. So let's look into liquidity run. A liquidity run is also a stop hunt. It's when price intentionally move towards an area where tons of orders are sitting. Usually, those are stop losses from retail traders. Smart money needs liquidity to enter a large position, so they will push price to obvious level, maybe high as a low or below support or resistance, to trigger retail's order, EDS, and reverse. When runs happens, liquidity runs usually happens as equal highs or low, previous swing low or high, support and resistance level, session highs or low. These are traps. The market runs through the level, take out stops, then moves to the weak direction. We have give numerous example of swing highs and low. Don't have to give it this time. Let's look into this example of how this liquidity run will happen using this swing low example on our screen. Now, how do we trade a liquidity run? Number one, identify a liquidity zone. As you can see, we are in uptrend and this is swing high. Here is swing low. In this swing low, we have another block. We are supply and demand traders. We said they are pending order. And SMC trader, we equally see endorsement inside the zone. They may use this other block as their entry position. And you can see as price going through this very zone. What happens here is called liquidity run. Whenever you have this type of formation running through other block, support and resistance, equal high or low, swing high or low, is called a liquidity run. What makes it a liquidity run? We see three or four consecutive candles running through the other block or support and resistance. Once you have that, then next thing we have to do is to look for confirmation. Breaker block for entry, fair value for entry after market structure shift. But this is my best entry pattern that I use. I use market structure shifts. So this is the market structure shift I use. I will move down to lower time frame. As we have 15 minutes, I will move down to 5 minutes time frame and look for this type of formation. Market created low, another high follows. Have a break of structure. Know that whenever we have a break of structure, it's likely price we present us with opportunity of in a breaker block or fair value gap form inside the zone. So once we have N here, set our pending order inside the fair value, target the opposite direction. So that's how to trade liquidity run. Hope this is clear. So for those of you who have watched to this extent, I will give you a pro tips. Liquidity run often happens right before a big move or sections open. Watch how price behave during London and New York opens. Liquidity grabs happens a lot during those times. So let me recap. Liquidity run equals to stop hunt happens at obvious highs or low. Institution run price through those stop zones to feed their big position. Wait for sweep, then trade the reversal with a confirmation. If you have been stopped out some time ago or you are facing that as challenge during your trading on this trading journey, now you have known why. Then trade the opposite direction. Let's move into the last topic before we end this video. Next is draw on liquidity, which is the last one for this lesson today. There are other types of liquidity, but what we learn today are the most important. So what is draw on liquidity? A draw on liquidity is a level or area on the chart where there is high concentrations of orders and the price is being pulled towards it like a magnet. So think whenever you hear about draw on liquidity, think about where price is likely to head to after your analysis. That is what is draw on liquidity. Smart money, banks, hedge funds, institution, they need liquidity to enter and exit their massive profit, right? They see your stop losses, buy stops and sell stops. Stocks around an obvious highs and low. So price get drawn to those areas to unlock their liquidity. Remember the statement, they need a zone to enter and exit their trade. So if they enter, taking you out, they will also move out, taking you out. You understand? That is what is drawn on liquidity. Think about it like a magnet. So types of liquidity target. Here are some example of liquidity target. So let's look into the types of liquidity target. We begin with equal highs and low. What we have here, we have relative equal high. Down here is equal low. Why do I call it equal low? This is a proper pullback. I mean, the zone, this targets, this candle here has been taken out by this push. So automatically here becomes a valid pullback. That's why I call it equal low. Price is likely to move down to this very zone, take out liquidity and move out. So let's say that's happened. Beautiful. You can see that liquidity has been taken out. And mind you, as we are combining everything here, well, what we are giving out is draw on liquidity example. Looking here, you see that price take out, price sweep out this very low. As price sweep it out, we look for entry model. And if we have run on liquidity towards the zone, this is what will be like. Price will run through this very zone, maybe 2 or 3 candle. But the fact you know what you're doing, you look for market structure shift, target the opposite direction. Hope this is clear. Now let's look for entry model, but we are not treating entry model here. There are so many entry model out there, but let's use the one I normally use, which is change in market structure. We have 1 hour time frame, so 5 minutes time frame would be our lower time frame. But let's see what happens 5 minutes. So we have to wait for structure to form. The price should give us a push down, take out this low. After that, we have a market structure shift in the target zone. If that happens, then we take the trade. If it doesn't, then so be it. Beautiful. You can see what happens here. We have a market structure, new structure view. You have to take out this very low. Then we want to see the price take out this high, 5 minutes. If you take it, then we may use this breaker block, or if a fair value gap forms, during the time of taking out this high, we take our trade. So let's see price breakouts massively from this. I don't think it will be back. But let's see what happens. So break a block zone or stop loss below this. Break a short long stop loss below here. Go for 1, 2. What it is to is very okay. Let's see what happens. Not tapped in yet, so let's still wait if magic will happen. Let's price have moved a lot. You still holding the trade, just a gambling, but it's a better entry though. Let's consider just little profit, just little profit. That's what it is. Then let's look into previous swing highs and low. I'll give you numerous example of previous swing high and low. I will not go in details with that. So another type of liquidity target we have here is this. Looking here, what we have this low here, low, and it's having swept out with a liquidity run. Price still run out here. You can see this is a liquidity run, right? So if you have a good market structure shift there, here will be our draw on liquidity. This zone will be our draw on, right? So as you're using this 15 minutes, our lower time frame will be 5 minutes or 1 minute. Let me use 5 minutes just to save time. Can see already have a structure. Yeah, price need to take this out. We have a beverly up, then we enter the trade here. As price, take it out. So draw happens, it happens. If it doesn't, a bit. So price leave us again. Let's see. And has no entry before we hit our draw on liquidity target. So this is the example of previous swing low and high. Let's look into imbalance zone. That is fair value gap. So so next is imbalance. What is imbalance? Imbalance is inefficiency. You can see here we have a breakout structure. Price take out this high. Our next draw on liquidity zone. Price run through breaking out. Dividends market structure shift. So we have turned from uptrend to downtrend. And this is what I want to show you. This is example of inefficiency. This is a fair value gap, right? Our next draw on liquidity is this. It should be our next on liquidity. Can see as price respected the fair value gap zone. Yeah, this very zone. That is the inefficiency we have. The imbalance. Price respected it. Go to this draw on liquidity. Sweep here. Move up again. And leave us with what? Leave us with another high and low. The next draw on liquidity. Yeah. So do you see how it works? That's how combine liquidities. When you're using liquidity, you don't need to pay much attention to the market structure. You will just pay attention to those areas of target where institution move to. It attracts price. Why? Because it's full of stop loss, pending orders, entry that's for the big players to enter the market. So we got to wrap it up here. But before we go, I need to show you other block. So looking at the screen, what do you have here? Price was in uptrend, breaking off structures. This is a war high. And the next draw on liquidity after this run, we say liquidity run, but you can call it sweep because the first candle closes above this, the next candle rush back inside. So we can categorize it as a sweep. But if it's two candles that close above here, it's a liquidity run. Then yeah, because they draw on liquidity, you can see how price move from this high to this low, targeting liquidity. As you have taken out those people sitting here who said they are pending order, because some people will say they are pending order here, saying it's a demand zone. As they are out with a liquidity run running through this very low, you can see we have another block here, which is another liquidity target. Is a market price is likely to respect it and target this low here. That's how liquidity works. So let's see what happens here. You have to move down 5 minutes time frame to look for market structure shift because the other block has been mitigated. So as we have mitigated the high time frame other block, 15 minutes, let's wait for 5 minute structure to be created. That is, you want to see a high and low, then a breakout structure. We have one here. So let's let it be clear to us. It's not clear to us that this is a breakout structure. Then do we have any entry here? We have to use this first breaker block. This will be our entry, targeting 1:2 or 1:3. The next draw on liquidity we have here in lower time frame is this very low here. Now this is our next target. Thus, if price push through here, we target here. You see how we combine it. So we're going short this position, stop loss above here if you want to be conservative, but if you're aggressive trader who like tighter stop loss, your stop loss should be around here. And the here alone gives you 5 hours. But you're likely to step out, so let's see what happens. Boom, we are mitigated. So let's see what will happen if we jump. Still pushing through. Numerous are trying to take us out. Beautiful. Can see you have made your 5 hours. So it's left for swing traders to target this higher time frame draw on liquidity, but this gives you 17.28 risk reward. But you as a day trader and a scalper who's using liquidity, just find the next target, the easier target for price to reach, then you close for the day, because this will take a very long time. This zone will take very, very long time for price to reach out there. So we have to end it up there. You have seen how price targets liquidities. That is how to use it in trading. So guys, combine liquidity, draw with time of the day, this London high or low, that's where you can make tons of money. But we have to end it here because numerous example has given in this video. If this helps level up your understanding, smash the like button, subscribe for more smart money videos, and drop your comment if you want breakdown of liquidity voice, breaking of structure and endorsement, giving example on those liquidities that we have mentioned, whether it buy side liquidity, sell side liquidity, any types of liquidity. If you need a detailed video about that, we have to take it one by one from now henceforth till we clear it. But this is the general understanding about liquidity. I hope this video helped. I do me a favor because it took me very, very long time to compile this video for you guys. So you don't have to be ungrateful at the same time. You must show appreciation. So the second target is hit. Like I told you, if you run from here, this is the second. And here gives you 7.25 hours if you're a day trader. So what are you looking for? This could pass you challenge in one night or in one day. So I have to go now. See you in my next video. Bye for now.